You see the screen that I'm sharing with you. You will find some of the details which I have shown here. And this is a very simple example that I have taken up, where at time zero we have an investment of 10,000 rupees. So there is a cash outflow that we are indicating. And for the next 4 years, there is a cash inflow which is same, constant. Now, before we come to this cash inflow, let me tell you the problem that I posed is that supposing the information given is what I've shown in the cell I2, which is being indicated with red font, that is 5,000, whatever the denomination of the currency. So this 5,000 is given as cash outflow, sorry, cash inflow, because these are the cash inflows from operation of the investment, from the operation of the business through that investment. So let us say the project has a life of 4 years and it results into cash inflow for next 4 years, every year 5,000, and it is given as before tax. Okay. Now, as you should know that we need cash inflow after tax. We need to adjust the tax information if the tax information is given. And like in this question, this information is given as tax rate is 30%. Now this tax rate is to be applied not on the cash flow but on the net profit. So we first need to calculate net profit before tax. Now to calculate net profit before tax from this cash flow before tax, we need to also deduct the depreciation. Now, in the problem posed before you, the information given is that investment is of 10,000 and life is 4 years. So, given this two information, that life is 4 years and investment is 10,000 years, if there is nothing else given, we need to assume about the depreciation method. And the depreciation method here would be straight line method. And we also need to assume about the scrap value, because it is not given, and that also to be assumed as zero. If it is not given, so it will be assumed as zero. So these two assumptions are flowing from our knowledge of accounting. Supposing the method had been given, it would work accordingly. I'll come to that part little later. Since the method is not given and uh, depreciation is to be calculated accordingly given the lifespan of the asset. And since the salvage value is not given or scrap value is not given, so it is to be taken zero. Supposing salvage value would have been given, even if we applied the straight line method, that salvage value has to be adjusted. So in this case, we are taking depreciation as 2,500 rupees per year, or whatever the currency you want to take, 2,500 rupees per year. So in this cash flow before tax, we add no, we're not adding this. We have calculated the net profit before tax. Now in this net profit before tax, which is coming out to be 2,500, now we have to compute the tax. So tax on this 2,500 at the rate of 30% would come out to be 750, as you can see from the cell information, that we have multiplied 30% with the net profit before tax, and we get the information about net profit after tax. And now in this net profit after tax, we will add the depreciation back. So when we add the depreciation back, we get this cash flow after tax, right? So this cash flow after tax is nothing but summation of net profit after tax plus addition of depreciation. Why are we adding depreciation back? Because we want to add back all that information, financial information, which is a non-financial expense. So depreciation being non-cash expense, not non-financial, non-cash expense. So this non-cash expense will be added back, and so we get this value of 4,250. So this 4,250 is what we have written here. So this value is coming from this calculation. So in this particular sheet, this is what I want to emphasize here, that if the problem posed before you when you are doing capital budgeting techniques, if the problem posed before you does not give you cash flow information, or it gives you cash flow information before tax and taxation information is given, in either of the case, you need to calculate cash flow after tax. Now, in this case, cash flow before tax is given, so we need to arrive at the value of cash flow after tax. Supposing information was given as net profit before tax. So again, from there you need to arrive at this final information, which is cash flow after tax. Because you need to adjust tax. Why you need to adjust tax? Because the financial system or financial information is subservient to the taxation. Taxation is beyond the control of the company, and therefore we have to adjust that. At the most, what one can do is, and I'm just adding this information to give the perspective, that supposing you have different industries where tax rates are different. So given different tax rates, you may find, well, where the tax rate is less, maybe the profits left with you becomes higher. So in that sense, you may take care of that while choosing the industry. But once you have chosen the industry, given the industry that you have chosen, profitability is determined by the nature of business that you are doing, and taxation is determined by the taxation policy of the government. So now possibly maybe one can say, why not we choose where the industry where profitability is higher and tax rate is lower? Yes, one can possibly do that. For example, there could be a situation where industry is in a growth stage. There was some time back when mobile communication was introduced. So this mobile service and mobile devices, these were into growth stages for many years to come, and therefore these were profitable sectors of the economy. So you have this choice at that stage, but once you have made the choice, you need to take into account the information which is relevant to calculate cash flows. Of course, when you are choosing a high profit low tax industry, possibly you are also choosing a situation where more entrants will come in. If it is a free for all, if it's a free competition, and therefore there is no restriction, no licensing issue. Like here there are issues when you talk of telecom sector. There are possibly issues of entry barriers in the sense of investment required, or entry barrier in the sense of spectrum available for you to provide telecom services. But let's say you are not in a telecom business, but you are in a mobile devices business. So you may find, because the telecom sector is growing, so mobile devices business is growing, and therefore many more entrants will enter into looking at the opportunity that it's a high growth industry. So that's how the industry dynamics become relevant there. But given the choice that you made, so you have to work out your projected cash. Sorry. So you work out your projected cash flow. So this projected cash flows that you have worked out. So here we are showing, given the life 4 years, 4,250. So in this particular example, I actually wanted to emphasize the part that you must be careful about the information, the financial information that you need. Because if you don't have that information, your first step is to arrive that information. And as I was mentioning, in the techniques that we use in capital budgeting, important techniques like payback period method, net present value method, internal rate of return method, these methods need cash flow information. And if taxation information is also given, these methods need information of cash flow after tax. So you need to arrive there. Once you have arrived at that, then you look at the discount rate which needs to be applied to do the discounting, if you are talking of net present value method or internal rate of return method. So in this case, since we are talking of net present value method, and in this particular problem, the in this particular problem, the discount rate given is 13%. So we are accordingly, you know, applying the discount factor. We are calculating the discount factor, and as I have been explaining it earlier as well, the discount factor has to be, understood very well. Not only you need to understand how to compute it, you also need to be able to find out by referring to the discount factor tables. And there are two tables which are particularly relevant when we are talking of net present value here. One is we call it as present value factor table, the other is we call it as present value annuity factor table. So this uh, here we are explaining, uh, like we have calculated this present value factor using the discount rate of 13%, and I have built in the formula here. For example, this particular year, this is a first year which is to be discounted to the time 0, so raised to the power that we have used is 1. The formula remains the same, but we apply it for second year with raised to the power 2. So references to this value t time 2, and likewise this information is being calculated. Now, since I have built in the formula in this, if once I have done this exercise, you will find, well, if I change my discount rate to 13% to 10%, the discount factors will accordingly be computed, and we should be able to verify from the present value factor tables also for present value annuity factor tables. So that's how present value factors are discount factors are arrived at. So this discount factor is multiplied with cash flow, so you get the present value of each of the cash flows, and that's how you calculate your net present value. So this net present value, I have shown it in red font, which is 3,471.928. So this 3,471 rupees and 92 paisa, if we are talking in rupee terms, is the net present value. And this 10,000 is our investment. And if you look at only present value, so this will be 13,471 rupees 92 paisa. Again, if we are talking in rupee terms. Now, there is another way to calculate the same thing, provided your cash inflows in future years are same. Like in this particular case, cash inflows are same, which is 4,250 for each of the 4 years. So instead of applying this discount factor separately for each of the 4 years, we can put them together. We can add them together, and so we get a value which is 3.169865. This is what we call as present value annuity factor. So this comes from a different table and is nothing but a cumulative value of the discount factors. So using this formula, I have calculated this particular one, and so I find that net present value, whether you calculate using present value factor or you calculate using present value annuity factor, in both the cases the value is same. It has to be same. If it is different, that means there is some mistake we have committed somewhere. So this is how this becomes very important to understand. Now there is a condition that we have put in here, that cash flow should be same, but then possibly, supposing you have cash flows, for taking a different example, supposing you have cash flows for 10 years, and of these 10 years, let's say the cash flows for 9 years or first 9 years is same, and only the 10th year different. So what you could possibly do is, you can use both the formula, present value factor as well as present value annuity factor. For the first 9 years, you may use present value annuity factor, so you can consult the present value annuity factor table. And for the 10th year, you may use the present value factor and you may consult a different table. But by doing this, instead of doing it calculation 10 times separately, you can do calculations only twice. So idea is to arrive at a efficient method. So which is the efficient method is very important. Likewise, supposing the situation is reverse. Reverse in the sense that for first year the cash flows are different, but for the remaining 9 years the cash flows are same. So now you could possibly again use present value annuity factor here as well for the next 9 years, 9 years after the first year. But you have to do some adjustment in this present value annuity factor formula. That is, in the table you will get a present value annuity factor for 10 years, and out of this you deduct the present value factor of first year. So when you do this, you are able to arrive at the present value annuity factor for the 9 years starting from second year to 10th year. So that's how there are different ways of applying present value annuity factor. And so this you need to understand well, so that in the practical exercises or in a test that you may undergo or in an examination, you may arrive at a method which is faster or less time consuming. Okay, now that we understand these basic things, what we could possibly do is, because my all these cells are connected in a logical way, if I change my values now, you will find that I can arrive at information according to the situation. Supposing my project is where cash flows are not 5,000 but 9,000, so this will still show me the results, and my results are not going wrong anywhere. Or supposing this is like 2,000, so now my project has become non-viable with this scenario. But supposing I change my discount rate to only 2%, even now this particular one is, so if your cash flows before tax are 2,000, this project becomes non-viable even if your discount rate is just 2%. So it has to be somewhat higher. So like I was taking, maybe with 3,000 it will still work. Yes, there is a positive net present value that you are getting. So that's how you can change these values, and you can see different results in different scenarios. I think I stop here, and with this, you do get an idea of the importance of information about cash flow and how to compute if it is not given directly to you in the problem which is posed to you.